Meet Dave. $2,000 in his EUR dollar account. 3 trades already open, all doing fine. He spots a fourth setup. Clean, textbook. Exactly the kind of trade he's been waiting for. He clicks buy, and his platform throws back an error. Insufficient margin. He stares at his balance. It still reads $2,000, untouched. So what just ate his money? Nothing got closed. Nothing got lost. And yet the platform is telling him he can't afford a trade he clearly has cash for. The answer isn't in his balance at all. It's in a number most new traders never even look at, used margin. By the end of this, you'll know exactly what locked Dave out, how to calculate that number before it locks you out too, and why checking your balance alone can quietly sink an account you thought was healthy. Quick recap so nothing here feels new. Every time you open a single position, your broker sets aside a slice of your balance just for that trade. That's required margin. Say Dave opens one EUR dollar trade, and it locks up $200. That $200 isn't gone, it isn't a fee, it's parked. The instant he closes that trade, it's released straight back to him. One trade, one number, one lock. Simple so far. But Dave doesn't run one trade at a time. He had 3 open when he tried that 4th entry. So here's the question. Recap alone can't answer. If every trade locks up its own little slice, what happens to your account when 3, 4, 5 of those slices are locked up at once? That's where this stops being simple. Here's Dave's actual account the moment before that 4th click. Trade 1 on EUR dollar, $200 locked. Trade 2, a different EUR dollar swing, $150 locked. Trade 3, $200 locked. None of these trades talk to each other. Each one only knows its own slice. But your broker doesn't care that they're separate. It adds every single one of those slices together and locks that whole combined amount away from you. 200 plus 150 plus 200. That total, $550, is what actually gets subtracted from what Dave can use. That combined number, the sum of every required margin across every open trade, is used margin. It's not a fee, it's not lost money, it's just unavailable for as long as those trades stay open. And unavailable money can still block a perfectly good trade. Now you try it, pause the video right here. On your own account, real or demo, open your trade list and for every position currently live, find its required margin. It's usually sitting right there in your trade panel, sometimes labeled margin, sometimes shown per position. Add every single one of those numbers together, in your head or on paper. That total is your used margin. Got a number? Good, hold on to it. Because here's the relationship in one sentence. Required margin belongs to one trade. Used margin belongs to your whole account. One is a single brick. The other is the entire wall built from every brick you've stacked so far. Add a trade, the wall grows. Close a trade, the wall shrinks. Never opened a second trade? Then your required margin and your used margin are, for now, exactly the same number. Let's put that relationship into a formula you can actually use, not just a feeling. Used margin equals required margin of trade 1 plus required margin of trade 2 plus every other required margin for every other trade still open, however many there are. 10 open trades means 10 numbers added together. 1 open trade means the formula collapses down to just that one number. It doesn't matter what pair each trade is on, what direction, what time frame. The formula doesn't ask any of that. It only asks, is this position still open? If yes, its required margin gets added to the pile. If it's closed, it drops out of the sum completely the second you close it. Now, here's where Dave's confusion actually gets solved. Your account balance is the full pot of money you deposited, plus or minus whatever you've realized. Used margin is the slice of that pot, currently locked across every open trade. Subtract one from the other, and you get what's actually available to open something new, your free margin. Balance minus used margin equals free margin. Dave's balance said $2,000. His used margin was $550. That leaves $1,450 technically free. So why did his 4th trade still get rejected? Because that new trade needed more required margin than his $1,450 could cover, once you factor in leverage and lot size on top of it. Balance alone told him nothing. Free margin was the number he needed, and the part that actually saves your account the moment this number gets dangerously thin is coming up next. Let's take this onto a real EUR dollar chart live, right now. Here's how you'd hunt for this in real time. Pull up your open trades panel side by side with the chart, and before you even look for a signal, calculate your current used margin and your free margin first. Now say the chart hands you a bullish engulfing candle at a clean support level. That's a simple pattern, bullish in direction, and it's a reversal signal. Classic frame. Your entry trigger is a closeback above that engulfing candle, your stop sits just under the wick, with a little wiggle room so normal noise doesn't tag you out, and your target is set at a 2-to-1 reward against that risk. But here's the real point. Where this candle shows up on the chart matters more than the shape of the candle itself. And even a perfect signal is worthless if your free margin can't cover it. The pattern can be flawless and still fail. The stop is what saves you when it does. So back to Dave. 3 trades open. 550 locked as used margin, 1450 sitting as free margin. His 4th trade, at the lot size he chose, needed required margin higher than that free margin could cover. His platform did exactly what it's supposed to do. It blocked the trade before it could push his account into trouble. No error, no bug, no unfair broker, just the math protecting him. This, the way used margin quietly eats into what you actually have available, trade after trade, until one day a totally valid setup simply won't fit. This is the thing this whole video was building to. Balance is what you deposited. Used margin is what your open trades have already claimed. And the gap between those two numbers is the only thing that decides whether your next trade even gets a chance to exist. Let's lock in the pieces. Required margin locks up money for one single trade the moment you open it. Used margin is the sum of every required margin across every trade you currently have open. Your balance minus your used margin gives you free margin, and free margin, not balance, is what decides whether your next trade gets accepted or rejected. Write this one down. Amateurs check their balance, professionals check their free margin. Dave's mistake wasn't a bad setup. It was never once glancing at what his open trades had already claimed before he clicked the 4th. Same thing can happen to you, on any pair, any platform, tonight. Which pair are you tracking your open trades on right now? Tell me in the comments, and check your used margin before you answer. Next time, we take this exact gap between balance and free margin and show you the moment it turns into an actual margin call, and how far you can push it before your broker starts closing trades for you, not you.